But Senthil, by your experience, can you suggest some way by which we can buy the same stock at the same price on the same day?
Yes. It is perfectly legal, no hassles, but you need to have that additional amount of money with you.
Okay, so that's a great trick given by Senthil to our audience.
If you just buy shares and keep it for eternity, what additional income would the brokerage houses get?
Nothing, they survive on trading.
So they want to increase the number of transactions. And tax loss harvesting is the most noble way in which they can increase the number of transactions.
Welcome to episode number 6 of Money Biceps. We recently had two major events. One was the Iran war causing considerable market downfall, and the another is financial year ending or March ending as we Indians call it. And in this perfect storm of market downfall and tax deadlines, we had some of our friends getting notification on their mobile apps of Demat accounts. This notification was on tax loss harvesting. In India, you talk anything on tax that suddenly raises the eyebrows. People lend you their ears. To clear this air on what exactly is this tax loss harvesting, we have someone with 20 years of experience as a financial educator. He is founder of the company Horus Wealth and Wellness. Please welcome Mr. Senthil Iyer. Welcome, Senthil.
Thank you, Nikhil. It's always a pleasure to talk to you.
So, Senthil, my very first question. What exactly is tax loss harvesting or tax harvesting as people call it?
So typically we are used to hearing the term profit harvesting.
Yes.
Because the moment you say harvesting, you're actually kind of unlocking some kind of a asset.
Yeah.
Now, if it is agricultural harvesting, you're actually kind of harvesting the crops. But in tax terms, loss harvesting can be equally beneficial.
Yeah.
So how does it work? That will be your obviously next question. If you already have profits booked in the capital gains segment of the heads of income, it would make sense to also book some losses in the same financial year.
Okay.
And once you book some losses, you can actually set it off against the profits that you have already booked. So your net capital gain tax liability would reduce.
Okay. Let me explain this with an example as I have understood. For example, I have a stock Naukri.com, which I actually have and had bought it for 1400 rupees per share. And now, due to the market situation, the stock has fallen down to 1000 rupees. And that means a loss of almost 30% on paper at least. The net loss in this case is 1.5 lakhs, considering I have 375 shares of Naukri.
Yes.
And at the same time, I have a profit of say 2 lakh rupees on Reliance. So what you are saying is I can adjust this 1.5 lakh tax loss against the 2 lakh rupees profit on some other share or other asset. And I effectively pay tax only on 50,000 rupees instead of 2 lakh rupees. Is that what you mean?
That's correct.
Okay.
And even if you don't have that Reliance profit in this particular year, if you happen to book this loss, you can even carry forward this loss for the next 8 assessment years.
Okay. Okay.
So in which case, in whichever year you would be incurring or you'll be realizing profits, against those profits, you can set off this particular losses.
Prima facie, this looks like a brilliant idea, Senthil. What do you think? Should this be used by everyone?
Should it be used by everyone? The answer is no. There are always particular cases wherein you can take advantage of tax benefits.
Okay.
So I keep saying this, that you should always let the dog wag the tail rather than the tail wag the dog.
Okay. However, Senthil, your confirmation gave me a chain of thoughts. Look at it like this. So instead of paying a short-term capital gain on 2 lakh rupees on Reliance, I am actually paying capital gain on only 50,000 rupees. And that is essentially saving me 30,000 rupees in tax.
Is it really saving you that 30,000 rupees tax?
I would have anyways paid the tax on 2 lakh rupees. So if I'm getting a chance to save it by making a loss which is already a loss-making stock, why not?
So this is where we need to differentiate between tax saving and tax deferment. So what you essentially are doing is tax deferment.
Okay.
Because now that Naukri.com shares, you purchased it for 1400 rupees.
Yeah.
So original your buying price was 1400.
Yes.
Now the new buying price that you will have is of 1000. So even if you later on just sell it off at par with your original buying price, even then this 400 rupees per share would show as profits in that particular year.
Yeah.
So eventually you would be paying capital gain tax on this additional gain, which is not additional gain. It is only coming because of your lower buying price due to the tax loss harvesting that you did.
Okay. So let me put it this way. Let's say I have Naukri.com shares. They are currently trading at 1,000 rupees. I sell them off at 1,000 rupees as you suggested. And then I buy it back at the same price of 1,000 the immediate next day. And then it raises from 1,000 rupees to 1,400 rupees. And I take advantage of this tax harvesting. What's the problem here?
So that's what I'm saying. See, when you say tax loss harvesting, you are deliberately booking loss on a loss-making stock in your holdings, and then you are trying to buy it back.
Yeah, the next day.
The next day or a couple of days later, once you realize the money.
Yeah.
From this transaction. Normally, what happens is the money gets credited in 2 or 3 working days.
Yeah.
So that's why people generally have to wait for those couple of days before they can place the buy order again.
A question here. Why do you actually call this as a deferment? You said this is a tax deferment.
I'll explain this with an example. The same example that you said. But I'll do it with 1-to-1 shares, like one share of each.
Yeah.
So let's say in Reliance, you made a profit of 500 or 400 rupees, let's say. And here you have made a loss of 400 rupees. Let us keep it simple. So Reliance, you made 400 rupees profit on one share, and on Naukri.com, you made a loss of 400 rupees.
Yeah.
Which is mark to market loss. It is not booked yet. Let's say you sell it off. So you have plus 400 on the Reliance head, and minus 400 on the Naukri.com head.
Yeah.
Net, what is your profit? Zero. You are paying 0 taxes. So you're assuming that you've paid 0 taxes on the 400 rupees gain on Reliance.
Yeah.
So to complete the action of tax loss harvesting, you have to buy the shares back at 1,000 rupees.
Yeah.
So which you will do, let's say, tomorrow.
Yes.
So you got it back at 1,000 rupees. Now your buying price of Naukri.com is no longer 1,400.
Yeah.
It is now 1,000 rupees. And since you're hoping that it will recover over a period of time and you'll be able to book some profits on this investment also. But take the chance of just squaring it off at par with your buying price, 1,400, the original buying price.
Okay.
So then what will happen at that time? This 400 rupees, that is from 1,000 to 1,400, will show up in your capital gain.
Yes.
So you have not avoided paying tax on the Reliance gain of 400 rupees. You only deferred it till the time you would sell Naukri.com shares.
Okay.
At par with your original price.
Yes.
So that 400 rupees will show up whenever you sell the Naukri.com shares.
Okay. So sooner or later, I will have to pay the tax.
Exactly. So how long can you defer the payment of capital gain tax is the question here.
Okay. I have another point here, Senthil. Instead of paying the tax now, is it not beneficial to pay it in future, say after 1 year?
Of course, the benefits are minor because you're only saving the amount of interest on paying off that tax right now versus paying it, let's say 2 years later.
Okay.
So only let's say you can calculate it using bank interest. So on 400 rupees, let's say after 1 year, you get the opportunity to sell the Naukri shares off at 1,400 rupees.
Yeah.
Then that 400 rupees pay 6% or 7%, whatever you say, 28 rupees you earn as interest. If it's 2 years, 56 rupees you earn. That's it.
Okay. So for a very small amount of benefit in terms of time value of money, we are just increasing one more layer of transaction.
Absolutely.
However, Senthil, if it is so straightforward that you are deferring the tax, there is no real tax saving, why are these brokerage houses promoting this so much?
That's obvious, isn't it?
How?
How do the brokerage houses earn money?
We do transactions on our Demat account, buy, sell, and then they make money.
So if you just buy shares and keep it for eternity, what additional income would the brokerage houses get?
Nothing. They survive on trading.
So they want to increase the number of transactions. And tax loss harvesting is the most noble way in which they can increase the number of transactions.
So can we say that they are giving a false hope to people that your taxes are going to be saved?
You cannot say it is completely false. For instance, strategically, let's say you want to exit some stock which you entered wrongly. And you're okay with cutting those losses.
Okay.
You don't want to buy the same stock again. In that scenario, this works perfectly for you
Okay. Okay.
because you actually made a wrong move and you want to correct that move by exiting that stock.
Okay. So maybe the fundamentals of the company may have gone haywire in the recent years, and then you realize this and you want to cut short your losses. And that's the only situation you see that this tax loss harvesting can benefit to some amount.
Absolutely. That's why I said the dog should wag the tail and not the other way around. If you're deliberately creating losses in your fundamentally strong companies in your portfolio, there's one more risk actually.
What?
Whether you will get to buy it back at the same price.
Exactly. The 1,000 rupees you're talking about, I'm buying it on the next day, and the price may fall to 1,950
If
or
it falls,
1,050.
wonderful.
Yeah.
What if it doesn't fall? If
Yes,
it rises from there?
That's the risk.
And that's permanent loss booked.
Yeah.
That differential amount.
Exactly.
Towards the end of March, my brokerage app sent me a notification reminding me about the deadline for a chance for tax loss harvesting. So, knowing that the market had been steadily going down for the past month due to the war in the Middle East and the geopolitical situation not showing any signs of improvement, at least until then, I sold off some of my holdings with an intention of buying them back again in a few days at the same price or lower. When I told Senthil about it, he advised buying back all of those stocks as soon as possible. However, the next day, the broader market was noticeably higher due to some positive geopolitical developments. So we waited for the temporary euphoria to settle down, and in the next 2 or 3 days, I was able to buy back most of the stocks that I had sold. However, one particular stock did not come back to the level that I had sold it for, despite waiting for nearly 1 week. So, as advised, I bought it back at minor losses before it could climb any further.
But Senthil, by your experience, can you suggest some way by which we can buy the same stock at the same price on the same day?
Yes, but for that you need to have sufficient funds with you. So you can open 2 demat accounts.
Okay.
In one you can sell, and in the other one you can simultaneously buy. But both require margins. Obviously, selling doesn't require margins because you are selling the stock. You already have the stocks with you.
Yeah.
But buying on the other side would need the margin amount. So if you have those funds available, and typically for direct selling or buying of shares in the spot market, you need margin equivalent to the actual amount of the stocks that you're buying.
Yeah. So in case of Naukri, I will need 375 into 1,000, 3,75,000 right away available with me.
Absolutely. Additional, because the same day you need to show that amount in your account in order for that trade to get completed. If that happens, then you are giving delivery on one side in one account and you're taking delivery in the other account. It is perfectly legal, no hassles, but you need to have that additional amount of money with you.
Okay, so that's a great trick given by Senthil to our audience. If you have 2 demat accounts, you can take benefit of the tax law harvesting, provided you are thinking strategically and not short term in terms of just saving taxes. And you have a wider perspective of investing, not trading. Is that right, Senthil?
Yeah, that is right. I would like to add to this that instead of adding too many transactions, I would rather you focus on selecting the right stocks in your portfolio and holding it for a longer period of time and ensuring that all your stocks make a profit.
Absolutely. In fact, I have one more question for you, Senthil. This may be off topic. However, not the market is down, my own stocks are down, possibly stocks of everyone. Some stocks touching 52 weeks low, some touching 3 years low, and stocks like TCS, they are at 5 years low. What should be the strategy of investors in this market? Or rather, should I ask, what is your strategy nowadays?
See, at the cost of sticking my neck out, I would say that this war scenario is not going to end very soon. So we may have darker days ahead.
Okay.
So I would always step into this market with caution. However, if you have undeployed funds available with you, then this is definitely a good time to make a partial entry into the market.
Okay. In the fundamentally right stocks.
Absolutely. That goes without saying. Unless you are able to read the balance sheets of companies and figure out what is an ideal price at which you can make an entry into that stock, you should stay away from the stock market and trust other people who are intermediaries who claim to be experts, like mutual fund managers or PMS managers.
Yeah. So to conclude, we had a fruitful discussion on the current market situation as well as on the tax loss harvesting. So this is a buzzword and let it remain a buzzword. Use it strategically with an intent of long-term investing. Go behind it only if you have invested in some weak companies for which you do not see a future in long term.
And if you consistently have such stocks in your portfolio, then your portfolio construction mechanism also needs a relook.
Absolutely, absolutely. Thank you so much, Senthil. It was a pleasure one more time talking with you. And thanks for educating our audience on this crucial topic, which can many a times misguide people than help them. Thank you, Senthil.
Thank you so much, Nikhil. Always a pleasure.